The most common way people build wealth in Silicon Valley is through employee equity. And with 3 mega IPOs potentially on the horizon, we're about to see just how much wealth can be generated. Welcome to Smart Money, where we break down how the world of wealth actually works. So there are 3 important things that people don't often understand about employee equity. First of all, whether it's in the form of stock options or RSUs, it's not until what's called a liquidity event that you can actually turn that into cash. So a liquidity event is something like an IPO, an acquisition, or if it's a really hot startup, a secondary sale. And by the way, even if there is a liquidity event, which is a big if in the world of startups, doesn't mean employees are necessarily going to make millions. How much they end up with depends on a few things. If there is an IPO, usually there's a 180-day lockup period where employees can't really sell their shares. Also, you have to pay taxes on your RSUs as if it's regular income, and those taxes are due whether or not you sell. With stock options, you have to exercise them, paying the strike price and potentially taxes up front without ever really knowing what ultimately those shares will be worth. And finally, the market can be very volatile, and the stock price of a high-growth tech company can swing wildly. So what you end up with as an employee depends on market conditions as well. Now, for generational companies like OpenAI, SpaceX, Anthropic, there's potentially a lot of upside for especially early employees. But just how much those employees walk away with depends on these factors: timing, lockups, taxes. If you're a startup employee and you're trying to figure out what to do about your equity, go ahead and book a call with one of our advisors and follow us for more wealth breakdowns.